Yeah, hi. I have a question, and my friend here has a question as well. You were mentioning earlier with the no exceptions with the US, and from what I remember from quite a few years ago, I had some friends that when they were outside of the US for over 11 months, and they were filing that completely legally and then being exempt from the federal tax within the US. And so if I have a company here in Indonesia and I'm filing taxes here, are both of those going to suffice for being outside of that within the US, or could you speak into that more?
That's a good question. So on my slide, the first bullet point was FEIE. That stands for the Foreign Earned Income Exclusion. So for you're correct. If you are a lower income earner, then it is possible that all of your earned income can be sheltered from U.S. income taxes. Now, it still needs to be reported, but it may not be taxable to the US. So at the moment, so for 2020, the foreign earned income exclusion threshold is $107,600. It moves every year with inflation, but that's where it is right now. So basically, it means that if you qualify for the foreign earned income exclusion and you earn 107 or less, then it will be reported, but no taxes will be due to the U.S. So yes, you're correct. Now, as to the second part of your question, if you run a company or you have interest in a company outside, that's a whole different situation to the extent that. Remember, I mentioned that the U.S., the IRS, I mean, the U.S. government in general, they're big on information. Like they pays more attention to information than they do to money. Seems weird, and I say that because of the penalties involved. If you have an interest in companies outside of the US and you're not reporting that, the penalties are pretty aggressive. So, and there's certain rules which we categorize as anti-deferral rules. So if the company in Indonesia, for example, is controlled by US shareholders, then there's certain rules around deemed distributions. Actually, Indonesia has those same rules as well. So if you have, so I know it's a common thing. People think, hey, everybody sets up a company in Singapore, and Indonesia went wrong. Absolutely wrong. Absolutely wrong. If you control a company in Singapore from Indonesia, even though you don't take a distribution from it, you're deemed to have done so by Indonesia and they want to tax it. Same from the US. The US created that game. If you have a company, you control a company outside of the US, even though you don't take a distribution from it, and you're just letting money accumulate inside of it. The anti-deferral rules, and there are quite a few. There's the PFIC rules where you have to file an 8621. There's subpart F rules, and most recently the GILTI rules, thanks to President Trump's Tax Cut and Jobs Act. All those rules look for every imaginable loophole where it says, I don't care whether you took a distribution or not, you are deemed to have done so and you will pay taxes on it. So just to answer your question in two parts, yes, there's a foreign earned income exclusion for those who earn at the lower side of the scale, so 107 and less. That will be sheltered. Everything above is fair game as far as US taxes go. So there's that does protect you. It is probably the best benefit available to US exposed persons working outside of the US. But secondly, and perhaps more importantly, is when you run a company that's incorporated outside of the US, there are really special rules that apply and they are ruthlessly enforced by the IRS. So pay attention. Does that answer your question, sir?
Yes, thank you.
Sure.
Please subscribe, like, share, and comment below. Our books and upcoming events are available at htj.tax. Email us at help@htj.tax to engage us, to advise on international tax or business matters.